Today on InvestTalk, we discuss the difference between rate cut expectations and economists' rosy view on economic growth. Then we discuss the market bounce today and its staying power. Then we answer questions about Shopify, Cameco, and Synchrony Financial, and more. And at the end, we discuss the next potential catalyst for a leg lower in markets.
This is InvestTalk. Independent thinking, shared success.
Now, my main focus point is about the dichotomy between market expectations of rate cuts and what economists see as an economy that is still doing just fine, shall we say? Reuters polled 202 economists, and 56% of them responded that inflation in the global economy will increase by year end. And same with rates, okay? Now, they're forecasting the global economy to grow 3.1% this year and next, and that's an upgrade from the 2.9 and 3% forecast in April of this year. So just 4 months ago. Now, even with economists seeing things rosier, central banks are still expecting to cut interest rates. Now, growth rates for 24 of the 48 top economies surveyed were upgraded in the last 3 months. And 13 of those are developed, meaning large, that have a large impact on the global economy. 18 economies saw a downgrade and 6 were left unchanged. But the market is starting to price in aggressive rate cuts. Like I said earlier, 72% chance of a 50 basis point cut in September. And then you have just 2 more meetings by year end. And by year end, the market is expecting 100 to 125 basis point cuts, meaning 50 in September, 25 in November, and 25 in December. And maybe even more, if things go awry. Now, remember, going into this year, the market was pricing in 6 rate cuts. And we're through 5 of these meetings, and we've had 0. Okay? And so it's always interesting to see how the market swings and usually gets ahead of itself. Now, is the market getting ahead of itself now? Well, according to these economists, yes, they are. Because there's not a lot of impetus for aggressive, panicky rate cuts. And in fact, as I said yesterday, when you have this yen carry trade unwind, more rate cuts actually makes the problem a little worse, right? Because it closes the jaws between the cost of borrowing in yen versus the cost of borrowing in dollars or investing in dollars. And it forces that unwind a little bit faster. Now, what is the impact of that carry trade unwind? Not that much. Majorly, probably neutral. Okay. So it's interesting to see this dichotomy. Now, is the labor market weakening? Absolutely. And I think it will continue to weaken. And that's likely what these economists are missing. They tend to be a little late to the game or early to the game. They're humans. Their models are not perfect. And so just because a majority, this is like price targets on stocks, right? Never listen to a price target on a stock. Oh, this bank has this price target. This bank has that price target. They're just using market multiples. And, they're not looking at the macro environment, liquidity trends within the markets, et cetera. They're solely focused on that business. So are they pretty good at understanding whether the company is going to earn more or less money next year? Yes. But how that translates into market price is a very different story. And that's the same thing with economists, right? They're fairly good at the general direction, but they're not good at turns, frankly. And so just like they weren't good at predicting the turn into a recession, now they've kind of been lulled to sleep. And, that effective monetary or fiscal policy is starting to truly weigh on the economy. Now, is it a recessionary environment? Probably not that. but certainly an environment where there's room for the Fed to ease. And I've said this before, that the Fed is likely going to stop its hawkish stance sooner than it had been in the past. Why? Because of the fiscal situation. They can't allow a deflationary shock like '08. Let's look at it now. Inflation somewhere around the 3% mark. Their goal is 2, right? Their goal is 2. And so they're already talking about cutting rates, which they will in September. And they have not reached their inflation target. And so you have to kind of read between the lines here and understand their end goals. Their end goals are not really their dual mandate. Now, they're going to use those as excuses. They kind of have to pay attention to them, but they're going to jawbone based on their ultimate goal, which is to help the Treasury finance themselves. 60% of these economists said interest rates by the end of the year are more likely to be higher than they currently forecast instead of lower. Now, this was a poll that was taken just a week or so ago. And already they're way wrong, right? Because rates have dropped so much. So the moral of the story here is the reality is often in the gray area. So don't buy too much into the hype around, oh, this economist says this or this analyst says this. They're often wrong. And do your own analysis. Now, the next Invest Talk, we'll look into this topic. The great wealth transfer is unfolding in a surprising way. How will these changes impact your financial planning and future wealth opportunities? That story tomorrow, but for now, I'm Justin Klein. I'm ready to take your calls at 888-99-CHART. Now let's take a look at the market today. We had a bounce back day after the bout of volatility to the downside, and the growth side definitely bounced a bit more. Large cap growth up about 2%. Small cap value up about 0.75%. Overall, small caps were up about 1%, but the broad market in general was about that. The best sector, actually, the best area of the market was just mid caps, up about 1.13% on the day. So very interesting market that we have here. There's just a lot of near-term volatility that has been driven by what is happening over in Japan, as well as our central bank here. And so there was some central banks that came out, kind of quell things a little bit, and you got that oversold bounce. Now, the big question is this bounce just more technical? Meaning, I said yesterday how, actually over the weekend, before the yesterday's sell-off, was that there was support in the S&P right around the 5,100 mark, 5,125 to 5,075 in that range, and that's exactly where we got the bounce. But if you understand technicals just a little bit, you know that if you hang around that level for long enough, that's just gaining power to move down to the next level, which frankly would be around 4,900 on the S&P, and I still think that's certainly possible. And we'll talk a little later about why that is. But we're still in the midst of earnings season, so that's moving markets as well. You had Palantir that was up a lot today. Let's see, Lumen was up 93%. So that has had some good news here. Let's see, any other big movers on the day of note? Oh, I'm not really seeing anything. A few to the downside, but nothing major to the upside. So I think a lot is going to depend on what happens with the economic data as we go through the month. There's still a high likelihood that we will get a 50 basis point cut at the next Fed meeting in mid-September. And it's now at 72% chance there'll be a 50 basis point cut. And frankly, it wouldn't shock me, right? Just let's get this off to a strong start, this rate cutting cycle, and then we'll see how the market reacts to 50 basis points. And I would imagine they'll go meeting by meeting to see if 25 basis point increments are likely ahead. So that's probably what you're going to see for Fed policy, and we'll see how that manifests in markets. So far, it's manifested in dollar down, yen up, obviously. The precious metal market, that's been holding up. Bitcoin was up nicely today, so nice bounce back there. And mainly that's because, hey, the NASDAQ bounced back. And so there's definitely a strong correlation between the Qs and Bitcoin. But frankly, this bounce, it wasn't strong enough for me to say, okay, the bottom is in. So I think we still have some work to do, and we probably get another leg lower before the end of the quarter. Okay.
Hey, Justin and Lou, this is James from Georgia, and I did some research, and I was just looking for some undervalued growth stocks, and Synchrony Financial came up. That's ticker symbol SYF. Could you please share with us your analysis on this stock? I sure hope you guys have a great day, and we love the show. Thanks.
All right, looking at Synchrony Financial, SYF, and this is actually a name we own for some clients. We've owned it, I think we bought it back in the high 20s last year, and now it's all the way up to 44, and that's after just a recent pullback from the low 50s area. So it's into support here in the low 40s, so that's good. And obviously, if we own it for clients, we like it. Now, is it a growth company? You know, it was growing nicely through the pandemic at $2.62 in 2017 and then $7 in 2021. But growth is certainly slow. And this year it's supposed to make $6.33. And, you know, that's a slower growth company now. It's not, I wouldn't even call it a growth name. I actually think it's just undervalued. Now, this is a spin-off of GE Capital's retail division. It's the largest provider of private label credit cards in the United States. Okay, so it partners with other firms to market its credit products in their physical stores. So think of when you are at, you know, a major department store or a major just retailer, and you know their main job isn't to take credit risk and, you know, deal with credit cards, but they want you looped into their loyalty programs. They want you looped into coming back and purchasing more and more. And so Synchrony is kind of the platform that allows them to offer a store credit card. And so they also do care credit. So those are the things that allow you to finance elective healthcare procedures. So think of, I know I used it when I was really young, when I did LASIK. I had LASIK in my 20s, and at the time I didn't have the money to pay the $5,000, and so I used care credit, paid it off, didn't pay interest, but a lot of people don't. So that's something that care credit, they offer care credit as well. So it's just a very good business, to be honest with you. Yes, growth has slowed, but they have a ton of capital on the balance sheet, nice 2.25% dividend here. Free cash flow, $9.5 billion. Very, very solid. Return on equity, 21%. And historically, that's about average. It's about average for its return on equity, which is very, very solid. So, you know, we like it, right? It's pulled back to support. It's a very good company. They're taking that cash flow. What are they doing with it? They're buying back shares. Look at this. Since 2016, they had 833 million shares outstanding. Today, that's down to 395 million. So they're taking so much of that free cash flow and plowing it back into share repurchases. And that cash flow is near an all-time high after dipping in 2022 and 2023. So we like Synchrony. You know, from a top line and bottom line perspective, it's not a huge grower, but based on the valuation, based on that cash flow, buying back shares, you know, it's just a winner. So we're going to give Synchrony a thumbs up. Now, I hope you've been telling your friends about the video version of our podcast over on our YouTube channel, and we get questions submitted to the comment section, and let's tackle one of those now. Iraq Dawn says, this question is a little different, but relates to something Justin has talked about recently. I am looking to buy property in Japan in 3 to 5 years, but I feel I need to start locking in a yen rate. I'm doing this in 2 ways. Buying yen through currency ETF FXY. That's a good one to just follow, frankly. It's if you ever want to know what the yen is doing, you know, FXY is a good one to pull up pretty much in any system. He says, and also transferring dollars from American bank to a Japanese bank. Is this a good strategy, and how fast should I look to complete this? My goal is $200K in a year and a half. Do I need to do this faster? The yen seems to be appreciating about 4% in the past few days. Here's the thing. Yes, the yen has appreciated. But will the yen keep appreciating? And near term, certainly possible, right? When there's positioning like this and those that are doing the yen carry trade, there's leverage and they're unwinding their position, and that's going to create a short covering rally in the yen. And that's what you've seen here. This is fast, it's swift, and that's typical of short covering rallies. Here's the issue, though. The Bank of Japan is going to have two options. They're either going to defend their currency or they're going to break the Japanese debt market. And when push comes to shove, they're going to sacrifice the currency over the bond market. That's what history says. In countries that have a fiscal situation like them, they'll devalue the currency and inflate away the debt. And we're probably going to get there at some point here in the United States, where Japan is much further along than we are. But that's what you have to. You're looking at the yen. You're looking at Japan right now. So I actually think near term, yes, some more strength, but I wouldn't be in a quick hurry because I do think the yen will eventually roll back over to defend the bond market.
Hey, Luke and Justin, this is Mike from Texas. I was just calling to see if you guys could do a quick overview and analysis of Ramaco Resources, ticker METC. It's a coking coal company, peaked price-wise maybe about 4 or 5 months ago, and it's come down, and I know that earnings are supposed to be coming down this next quarter, and I was just curious if you guys could just do a quick overview and possibly see what a good entry point might be. Thank you for everything that you do. Have a great night.
All right, looking at METC. METC is a symbol, Ramaco Resources. It's about a $623 million market cap, so small cap. And it's a United States metallurgical coal company operating in Western Virginia, South Virginia. And it's been in a strong downtrend recently after a nice uptrend. So bottomed in August of last year, around $7, was it? Yeah, 7 and change. Hit a high in basically January, 22 and change. Now it's down to 11.73. So you can see how volatile this is. It's basically down 50% from its high after tripling. And so that's typical of small caps, right? Especially in the commodity space. Now, you might be looking at that 4.7% dividend yield. That's probably what you're looking at. Okay, that looks good. The issue, though, is, once again, that volatility. It's down a lot, and for good reason. Earnings are falling 28% this year. That's after falling 33% last year. So down from $2.60 in 2022 to $1.25 in earnings this year. So it's to bounce back next year, but that's next year, and a lot could happen. Now, the free cash flow is solid, $86 million on a $600 million market cap. That's a nice yield. Return on equity is 16%. But that dividend, it's up and down. Okay, it can be up and down. So don't think that it's guaranteed. They do have a good balance sheet. I like the space that you're looking at, but I'm comparing this to yesterday's caller, also asking about a met coal company, which was HCC, if you want to go listen to that one. And it doesn't pay the big dividend. I think the dividend was in the less than 1%, let's say that. Not exciting, but a much better business and less volatile, and the relative strength was better. So this is a perfect example of don't chase the yield. Find the best. If you want exposure to metallurgical coal, who is the best? What is the best company? What is the best horse for you to ride? And when I say horse, I mean, what's the best business for you to ride? From a balance sheet standpoint, a profitability standpoint, the quality of its assets. And usually that is expressed pretty fairly in performance trends. And HCC is doing much better than METC for good reason. And so this would not be a name that's on my list. I would not to say HCC is the best met coal name out there. Keep doing your research, but I'm just comparing those two because that one's top of mind. I answered that question yesterday. So don't look at the yield. Completely ignore the yield. And that's for all of you. Everybody should ignore the yield. The yield is interesting. It can be part of the process of your analysis, but it's usually low on the list. It should be low on the list. And frankly, dividends are there to keep managements disciplined because they don't want to be the ones to cut the dividend. And that's usually the best thing going for a company when they're paying a dividend, is that it keeps them disciplined. But focus on quality businesses over that yield. Now, coming up, I have another interesting talking point. But first, let's play one more question.
Hello, Justin or Luke. This is Franz from New York. I'm looking at Comfort Systems Inc. today, ticker symbol FIX, F-I-X. This is a company I'd like to pick up in the mid-260s, and I really like its long-term growth potential. It's improving profitability, strong cash flows, debt management, the share buybacks. It's a very good company. It has a better valuation compared to its peers in the industry, so I'm really unsure if it'll actually fall 15%. So I'd like to hear your thoughts on the company and what to pay. Thank you as always, and I'll be watching on YouTube this time for the visuals on the charts.
All right. Glad you are heading over to YouTube. I encourage everyone to go over there, see all the data that I'm looking at. And this is a solid growth name. Now, it's not your typical growth name where it's in some sexy industry. It's not. It provides heating, ventilation, air conditioning services to customers in the United States, both institutional markets, industrial, commercial, etc. And once again, not a big dividend, 0.4% dividend yield. But earnings this year are supposed to be at 58% and 14% next year. So they have developed a system at Comfort Systems to really drive cash flow and profitability. And the free cash flow right now is $621 million on an $11 billion market cap. And frankly, their enterprise value is even less. They have net cash in the balance sheet. So 10.6 billion dollar enterprise value, And so that's about a 6% free cash flow yield, which is solid for something growing this well. And the return equity is 33%. Now, that's on an all-time high. That's much higher. This company's been around a long time, since, I have data going back to 98. And its profitability was it was solid, but it wasn't amazing. It wasn't in the high 30s, mid 30s, which it is now. So the question is, what has changed? I would really want to do a deeper dive there. The technicals are just fine. It's just consolidating here really since February in the 300s. And that's after a big run. That's very common. You go on a big run. It bottomed in October of last year at 150 and then ran up to 300. So it doubled in just a matter of 4 or 5 months. And when you get that doubling, it needs to kind of go sideways, consolidate that move, and see how real these earnings are. Now, the risk here is that if earnings come in and growth doesn't knock it out of the park, a 15% drop is not out of the realm of possibility. The second quarter came in good. 40% year over year revenue growth, which is higher than the 31% in Q1. And earnings came in at 94% growth, higher than the 78% growth in Q1. So acceleration in that growth. But what's interesting is that it didn't break out of this consolidation range. In fact, it was down a little bit, and it's just been sitting here around 300. So I like the technicals, but it worries me that, it had a blockbuster great earnings report, and it didn't fall through to the upside. So that's interesting to me. It's of note. Maybe not an end all be all, but it's of note. Okay. So I like what you're looking at. But, I wouldn't probably go all in here. I might add the position slowly. And if it does start to break out, maybe be faster in there to, catch it before it really runs again. But I like that you are focused on good quality businesses. And I'm going to give Comfort Systems a thumbs up for a small position to start. Now let's talk a little bit about vol control funds. And this is a likely exacerbator of the recent downside in markets. And these are systematic investment strategies that buy equities when the markets are calm. So that's why the VIX is so important. They look at what is called realized volatility, what's happening now. And when the volatility rises, they call it degrowth, sell positions when turbulence arises. And they stay long when there's low volatility. You said this before. A low vol environment is good for equities. And that's what these vol control funds tend to do. And they tend to buy a lot of stocks when things are going really, really well, because there's not really anything to worry about. They're full tilt, 100% allocated to equities. And then when volatility starts to spike, they have to sell. And recently they sold $83.6 billion of US equity futures over the last 2 weeks as volatility started to pick up. But they've only recorded these funds have only reduced 3.2, the pullback in their allocation has only happened 3.2% of the time over the last 10 years. So this is kind of a 3 standard deviation volatility event for them. And it shows you that this is something that happens when the environment gets a little choppier, a little more volatile, and can be a catalyst for a sharper market move. Now, equity trend following advisors, we call them CTAs, sold about $12.5 billion over the last 2 weeks. They're another type of systematic rules-based fund that tends to ramp up their selling when volatility or trends, reverse. Okay, right? Equity trend following CTA advisors. That's exactly what you would think it would be. They're following the trend. When the trend breaks, they tend to sell. And they sold about $36 billion $12.5 billion over the last 2 weeks, but they could sell another $36 billion if we get another 4% sell-off in markets over the next 2 weeks. So that is another potential source of selling if the yen carry trade brings us to more volatility, more downside. And that's something I'll talk about a little bit later is this over? Okay. But if it isn't, this is another source of potential supply of equities that will come on market to be sold and push down the equities. All right, now here's another question from the InvestTalk YouTube channel. Dan Riley says, Justin, Luke, great topic, lots of food for thought. Thank you. I have questions about Cameco. The price is down 16% over the last month and even more on July 11th. What's their exposure to China? Does this have anything to do with the price drop or buyers at this price? No. This is a seasonally weak part of the year for not just equities, but it's commodities as well. And uranium, there's not a lot of movement, a lot of spot price movement. So there's not a lot of price discovery. We expect that to happen more in Q4. But I think there was just over positioning and market had to sell something. It did pull back to CCJ, did pull back to major support in the mid 30s. And we actually just started to add more positions, more of a position for clients. So it's nothing to do with China. China is buying uranium from the rest of the world, and it's a global market unless there's some sort of regulation around Russia, and there's been talk about that. So that would be the only thing I think would move prices, but it would probably move it positively as opposed to negatively. So I do think this is a good buying opportunity down here on Cameco CCJ, the largest North American uranium miner. There's a lot of uranium explorers, but Cameco has a ton of actually proved reserves that they can tap kind of at any time and take advantage of the upside in price. Now let's play another caller question now.
Hi, my name is Paige. I'm calling from Silicon Valley, and I'd love to hear your thoughts about Shopify. Curious if you'd buy it at these levels and where you might feel comfortable getting in on the stock Shopify. Thank you. Love your show.
Appreciate it. Now, Shopify, another one of those growth names that peaked out in late 2021, and they've always kind of struggled with profitability. They were barely profitable in 2022. They made 73 cents last year, so let's make 99 cents this year and $1.28 next year, and it's a $54 stock. So it peaked out around $170 per share, which at that point was egregiously overvalued. Now, if you're talking about $1.28, you're talking about a mid to high 40s forward-looking multiple. That's still expensive, right? And growth is certainly slowing to a degree and expected to slow from the high 30% range or low 31% range in growth last second quarter and on the top line revenue. And this quarter is supposed to be only up 19%, okay? And so earnings are supposed to be up 35% this year, 30% next year, but they've historically not really been able to hit those numbers. And if you look at free cash flow. That is positive. It's about $1 billion, but it's still a go by enterprise value, $63 billion enterprise value. That is a less than 2% free cash flow yield. That is not good. That is very low. It's extremely expensive still. Yes, free cash flow is at an all-time high. That's good. But what are they doing? They remember in cash flow, there's not stock-based compensation calculated in that. And the amount of shares outstanding continue to grind higher and dilute shareholders. And profitability, return on equity is still negative 2%. It's improving, but it's still not to a level that makes this anywhere close to a reasonable valuation. Where would I buy it? In the 20s. In the 20s. So that means it has to be cut in half from here. Then I would think about it. And frankly, the technicals are bad. They're poor. They continue to stair step lower. So it would not shock me over the next 12 to 18 months that this does hit in the 20s. And then obviously I'd still reassess it. I wouldn't just blindly buy it. I have to see where the business is then. But I wouldn't even think about it until it's in the 20s. Thanks for the call. Now, 2024 is moving fast, and we are into the warmest days of the year, and volatility is heating up as well. So the big question for you is, are you prepared for this market environment? And if you're a serious investor, you need to adjust your thinking, your strategies. This is not even your parents' market, right? This isn't the 1990s. This isn't the post-financial crisis economy where rates were pinned at zero. This is very different, right? You have deglobalization, you have higher inflation, you have higher interest rates. Different trends are emerging. And the big question is, are you prepared? And if you need help, take advantage of our free portfolio review assessment via telephone or Zoom. And this is where we look at your portfolio, run an analysis, and give our assessment of if you're on the right track, if you're taking the right risk, if you are on track to reach your goals, something we do for clients, build financial plans. And we do this by providing unbiased guidance both on and off air and practice parallel investing, which means we invest right alongside our clients. So I encourage you to reach out. Just head over to investtalk.com. Let's go talk to Chris in Georgia looking at TPL, which is Texas Pacific Land Corporation. Do you own it or looking to buy it?
I was looking to buy it. I wanted to get your opinion on it. It is up a lot already on the year, and I just kind of wanted to get your idea on the fundamentals and see if it's overvalued at this time.
Well, it is a bit rich, but I do love their business. And what they do is they are engaged in the sale and lease of land that they own. They retain oil and gas royalties, and they basically manage the land that they own. So they work with the drillers, and they manage the land for the drillers, right? They're not good at that. They do wastewater treatment, infrastructure development, disposal solutions. So support the oil and gas companies in their fracking, in their fracking operations. And so it's a very solid business. Return on equity is very high, 45%. They pretty much have no debt on their balance sheet, which is very good. And pretty good cash flow. But once again, it is expensive for me. So I like the technicals. I like that this is I like what they do, right? The picks and shovels in the business. But certainly if oil prices drop, you're going to get volatility. You saw this recently. It went from $900 per share all the way down to $4 and change. So for a trade near term, I think the technicals are fine. There's probably some more upside, especially if oil stays buoyant. But naturally, this is going to be a very volatile name. And this is a name I'd rather buy like on a dip. Gets back into the 400s, then I'd probably pick it up. But it'd stay on the watch list for now just because how expensive it is and the volatility of this space.
Okay, that's what I was kind of thinking. I wanted to get an expert's opinion. I appreciate you.
Yeah, no problem. Anytime. Thanks for the call. Now, lastly, let's talk about the recent unwind of the yen carry trade. We know that's kind of the big story over the past week. And it's shaking out many asset classes, right? And the big question is the volatility over? We got this bounce, but could there be more ahead? And the simple answer is probably. Why is that? Because all of this is not unwound in just a few days. There's just the positioning is too large. And not every fund had to sell, right? Not every fund deployed leverage to where they were forced to sell. That's a small percentage or a percentage of those funds that are using a lot of leverage, but not all of them have the same leverage ratios. And so a lot of them could hold and wait to unwind their positions. So while some investors were scrambling, others were watching and trying to plan for a more orderly unwind. Okay. And, a lot of them use managed futures. They, naturally, this is a strategy that is easy to deploy leverage, but it's very hard to know the actual size of the positioning that's out there and how much is hedged. Remember, you can also hedge the currency risk. Now, it eats into your total profitability, and there are many of those funds that were hedged. But as the yen rallies, the cost of that hedge increases. Okay, so the initial move, they might be hedged, but if the yen continues to rally, then they're more forced to unwind their positions. Okay, so I think you do have more ahead. That's very likely, to be honest with you. And that's why I think you could easily see a bounce, but a lot of those funds are going to be selling into the bounce. Now, is there a serious collapse coming? Probably not. This is more of a small subset of funds. It can build on itself to a degree, but the liquidity in the broader economy, broader global markets remains relatively robust. And you see the Fed, the most important central bank out there, embarking on an easing cycle. Okay, so this might be a setback in markets, but it's likely to be something that's healthy, right? When you have too many players deploying leverage, then you get these shakeouts, and these shakeouts are healthy. It's like there's a book by Nassim Taleb called Anti-Fragile. When everything is just hunky-dory for too long, that actually builds up risk in the system. So like the Silicon Valley crisis last spring and this, both of those events are actually healthy for markets. Okay. Well, that about does it. I'm Justin Klein. This week's another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And now we've exceeded the 50 million download mark thanks to you. Fast approaching that 6-0. So thank you for continuing to listen and telling your friends. Independent thinking, shared success. This is InvestTalk. Good night.